Hi guys, welcome back. So, another bad day today in the market. Unlike all the other dip in this correction, today we have actually broke below this trend line, the blue trend line, that every time it backtests and gets supported, right? So does that mean it's gonna get worse and worse? When will this sell-off end, and what to do right now, and what does it mean for the Chinese stock market? Right now, the whole world, all the government is increasing their interest rate. The market is very fearful. On the other hand, China is actually cutting interest rate. So what does that mean for us? Let's talk about this. And in the end, we will update a little bit our stocks and the news recently. So after the long weekend, the market right away continued the falling from last week. And the most disaster section is the Nasdaq, which should be somewhat expected, right? As I kept saying over and over again, that it's going to be a sector rotation from the previous hot sector, such as the mega cap, the tech stocks, especially the FANG and the chip leaders that have been running up non-stop for the past few months. This correction hits a little bit overdue already. So I have been saying this for the last few weeks. I expect the smart money to move from Nasdaq to the Dow Jones sector, like the value stocks, and possibly also the medium to smaller caps as well. Because as you see, this is another day that in the top growing list in the Nasdaq 100, you can see the Chinese stocks being in the top growing stocks, or the ones that drop the least. And it's again Pinduoduo, JD.com, and Baidu. So the bad news is that we have dropped below the trend line, and if we cannot get back up within 1 to 3 days, it would be officially broken. This support for the last 2 years since the COVID crash. But the good news is that right now, if you look at the RSI of the S&P, it is already very oversold. So technically, it needs to rebound. Right now, RSI 22, and if we zoom out, now throughout the last 2 years, every time the RSI get to this oversold range, it would have the need to rebound. So if you did not take advantage of the previous rebound to reposition your portfolio, there is really no point to cut loss at this moment, or at least wait until it rebounds. For the past few weeks, the US 10 years Treasury kept climbing all the way to 1.88, today to be the highest for the last 2 years. So this should explain why the tech sell off so much recently, as well as the US dollar index growing from 89 last year all the way to 96. So I think this is pricing in the rising interest. Usually when the US dollar index goes up, the stocks at the emerging market would not do so well, as the money would flow in the US market, and usually the opposite when it goes down. Because when the US dollar goes up, it usually means the money is more risk on, meaning their risk tolerance is less. So when the US dollar goes down, emerging markets usually would go up. In the past years, at least the Chinese market, I have observed, has a strong opposing correlation with the US dollar index. And right now, overall, the short to medium term, the US dollar index is still trending up, but recently is under a little bit correction. You can see it had broke the support last week, trending down, rebound today, and should make another leg down, or at least a double bottom. And it might trend up again because the interest rate has not started to raise yet. Maybe once we start to have the first time increase of interest rates, we might see the weaken of the US dollar. So that's why I expect a rebound for the Chinese market and also the techs probably in this week. But overall, it's not over yet if the US dollar continue going up. So Nasdaq right now is on a downtrend clearly. And if I expect a little bit rebound for a few days, that means it may not make higher highs than last week and continue the downtrend later. Now, I don't know how long this would last, but I do think that the short seller cannot do too crazy, because it is earnings season coming soon for the FANGs, and they're mostly in the first week of February. The year of 2021 was a strong growth year for the big techs, so their earnings should not be bad. But what's after that, I'm not so sure anymore, because I think 2022 it's very, very hard to beat 2021 for the mega caps like the FANG, because as the base number was pretty high, so it's very hard to beat. So this is the comparison of the performance since COVID crash for Nasdaq, S&P 500 and the Dow Jones, where you can see that Nasdaq has been significantly outperforming the other two index for the last 2 years. Now let's zoom in and compare this since the beginning of this correction, so the beginning of December. And now you're gonna see the exact opposite, that the strongest is Dow Jones, second is S&P, and the weakest one is the Nasdaq. Sure, for the short term, Nasdaq might rebound more if the market start to rebound, let's say tomorrow or the next day or the day after tomorrow. But after this, I think this trend of Dow Jones outperforming the other two index would last at least for the medium term. So at least until the first half of this year, 2022. And why is that? Let's see. Now, the Nasdaq had been growing 145% since the bottom of COVID crash and 65% since the peak before COVID crash. And this is because of both the technology stocks have been growing very well these 2 years, and also because of the unlimited QE from the Fed. Sure, some companies have had very good growth rates, but really just a few individuals. So on average, I don't think the tech had grown their revenue by 70% in the last 2 years. During the 2 years, I would say the FANG stocks, the chip stocks, they have very good growth rate. But there are others that were affected by the COVID and had slowed down or even decreased during this period. So if we give it an average of 40%, which I think is already fair, then that means around 20 to 30% were pumped by the unlimited QE. In that case, the valuation needs to correct, like maybe around 20 to 30% for the Nasdaq, now that the Fed is increasing interest rates earlier than the schedule and at a much faster speed than everyone expected. Throughout the whole 2020 and early 2021, there was no problem for inflation, and the Fed were all promising that they're not going to increase interest rates until earliest 2023. And they were planning to start to increase in 2023, but now they're in a hurry to increase multiple times this year in 2022, and on top of that, reducing the overall debt. So that means they're not just gonna stop pumping money into market, but also taking away the money they have pumped in back out of the market. And if Nasdaq correct 20 to 30% from the top, it is only back to the level of summer of last year, which is still considered high valuation in a macro environment that is tightening. So even if Nasdaq correct 20 to 30%, it is still 40% up from before COVID. And on the other hand, if we look at the Dow Jones, it is up around 100% from the COVID bottom and about 28% from the peak before COVID. So I think 20 something percent is a lot more fair than 70% from the Nasdaq 100. So even if it needs to correct down to 20%, which is fair, I think 20% of growth for the past 2 years, because even inflation would drive it up, or the increase of oil price and the natural growth rate for the financial institutions, etc. So 20% should be fair. So in that case, Dow Jones only need a 5 to 6% correction, which have been done already. So I think there's a good chance that Dow Jones had done enough correction. And there are a lot of the Dow Jones stocks that still need to correct the valuation or recover from the COVID crash, such as Disney. Once the COVID is over, Disney is still the well-known Disney with a very strong brand. And Boeing, for example, it is still around 50% down from before COVID, even after a strong run up for the past few weeks. And the banks, for example, like Goldman Sachs, PE ratio of 5.9. So still quite cheap considering the steady growth rate. And also under the environment of rising interest rate, it should benefit the bank stocks, which, by the way, had a huge gap down today, and I ended up buying a call option. So anyways, that's why I think the Dow Jones would have less room for dropping in comparison, but more room for growing instead. So I wouldn't be surprised to see this trend continue, to see the Dow Jones outperforming. So overall, my prediction for the first half of 2022 is for Dow Jones to continue steady growth. S&P might stay flat and slightly uptrend. So here's my prediction for the first half of 2022. I see Dow Jones would continue with steady growth. S&P 500 would mainly stay flat and slightly up. And Nasdaq might have more correction to do. But I don't know how fast and how deep it is. But the sure thing is, after the correction, Nasdaq will still remain the strongest index out of all, because in the long run, technology would always outperform, especially right now we are entering a phase where technology would grow exponentially. So the correction is only short term. If you are a long-term investor, then the following few months might be the time to accumulate more and more shares, as long as you have patience and have spare cash to buy the dip in case it dips lower. So today was another day when the Chinese stocks are outperforming the US stocks again. Even with such a sell-off from the S&P, the Dow Jones, the Nasdaq, all index were down by not just a little bit. The HSI future can actually stay green. It's not green by a lot, but at least it had a very strong rebound. So the fact that it's green is already giving us some confidence. This morning during the pre-market, I sent the update on the Discord because even though the pre-market was already looking very scary, I saw that the FXI were already at the support. So that's why I said I would be adding the YINN. So the YINN, ticker symbol YINN, is the triple leverage of the FXI. So I took YINN because I have a higher risk tolerance. So why did I choose the FXI instead of the CWEB? Even though they have a lot of stocks that overlaps, like Alibaba, Tencent, Meituan, JD, Baidu, all the tech giants, right? But on top of that, it also contains some of the banking stocks like CCB, ICBC, CN Bank, Bank of China, Li Ning, the sports brand, etc. So it's more diversified. And because right now Nasdaq is still unclear to me, so I don't know how much the Chinese tech stocks would be affected by the Nasdaq. So I think it's not a bad idea to choose FXI at this moment because it's more diversified and not all in on the tech stocks. And compared to the CWEB or CWEB, it has a stronger correlation with the HSI. And you can see that it gapped down at market open and right away rebounded pretty fast. And in between, even though the market, like the S&P, continue making lower lows of the day, it is still staying up pretty strong, holding well. So I'm already very satisfied that we can make some profit on a day like this. So I set limit order in the morning before market opened at 8.7, 8.6 and 8.3. And I set stop loss slightly below that. So if the US market continue dropping in the next following days, I might grab more dips. And if not, I'm fine. Now, I am still bullish for IWM for this year 2022 because it had not grown at all throughout the last year. The whole year it had been going on the sideways. And in fact, every time it dips to around 207 to 210, it always gets supported. Right now, it is at this critical support again. So if you want to try it out to buy the dip, you can, but just need to have a stop loss below it in case it breaks the support. For me, I think right now it's 50-50, even though it is at a very strong support and might rebound from here. But judging from the market scenario, I have a little bit worried that it might make a golden dip before running up strong. If you look at the monthly chart, in the past, many times the Russell 2000 went on sideways for a while. It usually follow up with a golden dip that is quite fast or sharp before running up strongly. And I don't know if this would happen this time. I just know that if it happens, I would be very, very happy to buy this dip because I think it would do very well in this year. Now, in the end, let's update a little bit our stocks. LKN had a very good rebound. Even today, can run up 12% at most with the whole market selling off. So last week, I said LKN had got to the range of buy-in zone again, between 7.8 to 8.5, right? And once it touched that level, it right away got supported and had a strong rebound of at most 25%. So if you have grabbed the dip, make sure you have the profit limit set up in case things turn south, you can still lock in profit. Why is the run up? So first of all, LKN had increased their business scope, the registration, to add the sales of sanitary products and cosmetics. Why is that? I don't know. But it seems like LKN wants to expand because they have built such a strong brand over the past few years among the youth, the millennials. So right now they want to take advantage of the brand effect and do more business with it. That is good news. And on top of that, they are restarting the international expansion that got stopped 2 years ago because of the fraud incident. So that is another good news. But even so, I still take this as a technical rebound more than a full reversal unless it passed this trend line and can stay above that. So even though the whole world is increasing interest rate, China is doing the exact opposite. They just decreased the interest rates. Why is that? Well, because China has been tightening the whole year last year when the US stock market kept running up. It did not want to participate in the high valuation, or someone would call it bubble. Throughout the whole year, they were preventing for when the bubble popped. And because of the tightening and all the regulation or crackdown last year, so right now there is much more room for loosening up. So that is good news for the stock market. If you see the GDP reports, you can see that China had been slowing down last year. And that is expected because of all the crackdown from the government on the big techs and the real estate or education sector. But the GDP slowdown is actually may not be a bad thing for stock market. It is not a joke. If you remember last year, I shared this picture on the Discord and make a joke about it. I said no wonder the Chinese stocks are down because Chinese economy is going up, and no wonder the Chinese up because the economy was going down. It's because the economy is weakening. That's why the government needs to do more QE to help the confidence to boost the economy. That's why the stock market would go up, because there's more money inflowing into the market, right? So right now, from this point, I think we might hear many bad news about the Chinese economy to slow down, but I think most of it has been priced in the stock market already with the big fall last year. And the bad news might in fact create some good opportunities to buy the dip later. So this is what I believe at this point. And this is how I would explain why China is cutting on interest rates, and I think they would keep going with more QE tools because there is a lot more room to loosen up. I don't think China economy is bad, but it's more like they have been deleveraging for the whole year last year. So the stock market is a lot more healthier than before, and the valuation needs to correct because things have been oversold. Okay, now that's it for today. Now if you have enjoyed this video, please give me a big like and write me a great comment, and I'll see you in my next video. That's it guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.